Hi, everyone. Chris Johnson of Money Morning here today with a special guest. I have with me Chuck Carlson. Now, if you haven't heard about Chuck or of Chuck, he is the CEO of Horizon Investment Services and also CEO and publisher of the Dow Theory forecast. Now, I had an interesting thing a couple of weeks ago when I was writing about the transportations and actually a story about watching traffic on a bridge here in I-75. And it got me thinking about I needed to get Chuck online with me to talk to you about the Dow Theory because there are some things happening here. So without any further ado, I'm going to bring Chuck in right now. Chuck, it is great to see you. How are you?
Good, Chris. Thanks for having me on.
My pleasure. This is going to be great. Like I said, I was just writing about the transports. We had communicated a few months ago about the Dow Theory. So 1 and 1 equals 3. We've got kind of a Reese cup here with the peanut butter and the chocolate. Why don't you tell everybody real quickly that may not know about the Dow Theory? What is the Dow Theory?
Sure. The Dow Theory, which was developed in the 1890s by Charles Dow, the first publisher of the Wall Street Journal, basically looks at two things: the performance of the Dow Jones Industrial Average and the Dow Jones Transportation Average. And from the movement of those two indices determines whether the market's primary trend, that's the trend that typically lasts 12 to 18 months, if not much longer, whether the primary trend is bullish or bearish. Typically, a bull market trend under the Dow Theory is when you see both the Dow Jones Industrial and the Dow Jones Transportation Averages moving in sync and posting a series of higher highs and higher lows. So they're kind of either moving steadily higher or in a jigsaw higher, but basically posting a series of higher highs and higher lows, both averages. And that's important, both averages. The underpinning, the fundamental underpinnings of the Dow Theory really go back to really the origins of the Dow Jones Industrial and Transportation Index. Yes, they are stock market indexes, but when they were developed, they were also developed as to give you barometers on important sectors of the economy. The Dow Jones Industrial Average being kind of the makers of stuff, and the transports being kind of the takers or the shippers of stuff. And in essence, you want both of those areas of the economy to be in sync with one another if the economy is in sync. If one is doing something that the other one is not, that's divergence. And divergence can be a potentially yellow and move to a red flag from an economic standpoint as well as from a stock market standpoint.
Okay.
So it's a simple tool, but I've been in this business for over 40 years. And for my money, it's the best tool to give you a perspective. And again, there's that all important word, a perspective, right, on the primary market trend. And that's why, the Dow Jones Transportation Average might be the most economically sensitive index there is in the world, Chris. And so it is really worth paying attention to. Unfortunately, most investors don't. They focus on the S&P 500 or the NASDAQ or the Dow Jones Industrial Average, which is fine. But the transports really are kind of the canary in the coal mine, if you will, in terms of foreshadowing potential problems with the economy, potential problems with the broad market. So that's I think one of the big values of the Dow Theory is the emphasis it puts on the Dow Jones Transportation Average, which is really one of those averages that a lot of people don't look at, and they should.
Well, you know what? This brings to me something that happened obviously in the last 4 years in the pandemic. So that phenomenon between these two indices, what happened to the transports during, right after the pandemic? We hit that in 2020 or so.
Well, they got obliterated, as did, a lot of other indices. But, they were kind of foreshadowing some issues there that in the economy. And then, of course, everybody kind of got blindsided by what happened with COVID and basically the shutting down of the economy. And that was clearly reflected in the Dow Jones Transportation Average back then. And that's why it's really important. It is difficult for the broad market. And when I say broad, I'm talking other than just the Magnificent Seven or the mega cap tech stocks. It's very difficult for the broad market, a market of not just large cap stocks, but mid cap stocks and small cap stocks. It's very difficult for a broad market to show a broad advance without help from the Dow Jones Transportation Average. If the transports are really lagging or sluggish or heading lower, that is not a good sign for the broad market. You may have certain real mini slices of the market being able to fend that off. But by and large, it's very difficult for a real broad market rally to occur in a sustained way without participation of the Dow Jones Transportation Average.
Well, that's interesting you say that, because we talk about, you mentioned them, the Magnificent Seven, and I don't know how many. I think we dropped Tesla from that list, right? I think they're kind of still hanging around, but you've got those large cap technology stocks. Obviously, the one out there that everybody loves to watch is Nvidia right now,
Right.
And then right up there is Microsoft and maybe Amazon, but Amazon would be closer to the transports. But my bringing that up is that when you look at the S&P 500, and this is just off some of the technical things I've done here, only about 50% of the companies in the S&P 500 right now are trending above their 50-day moving average.
Mm-hmm.
And for a technical measure, for someone like me, you mentioned 12 to 18 months for the Dow Theory. That's looking at 4 to 6 months for me. That's kind of one of those warning signs. So the fact that you've got something that's longer term right now, do you feel like this market is just being propped up? We call it breadth, we call it all of these things. Is it a case of just a special little slice, as you referred to it, holding us up?
It very well could be. And again, we kind of let the market tell us the story ultimately, and tell it through the prism of the Dow Theory. And so right now, as you and I talk, the Dow Theory is still on a bull market signal. The last major signal under the Dow Theory was July 2023, when the Dow Theory turned from bearish to bullish. And it was a nice call for the Dow Theory. I mean, since then, I think the Dow Jones Industrial Average is up 12, 13%. I think the S&P and the NASDAQ are up substantially more than that. So, the Dow Theory had a nice call there. And for the most part, again, I've been doing this for over 40 years, and no market timing tool is perfect, but it has a pretty good record. And it had a nice turn in July of 2023, and we haven't had a change yet. So, as you and I talk, the primary trend is still bullish. However, we are getting close to what could amount to be a kind of a pivot point in the Dow Theory, based on two things. One, the Dow Jones Transportation Average has been fairly weak here. In fact, it has been making a series of lower highs and lower lows. And it recently went to what we felt was a decline below a fairly significant intermediate point. And on the chart that you have up now of the iShares Transportation Average ETF, you can kind of see that mapping out here of that period of kind of lower lows and lower highs. We had that pretty sharp decline, and then we had a pretty anemic rally, and then that decline came down below the previous decline. And now we've had a kind of another anemic rally. So that is in a downward trend for sure. Now, as I mentioned at the beginning of our discussion, one movement of the average does not necessarily determine a trend. You need to have both of those averages confirming one another. So what has been really kind of propping this market up at this point, from changing from bear to bull to bear, are the Dow Jones Industrial Average. They have not yet gone below what we deem a significant point. However, they are only about 2% above that level, and that level is the April 15th level of 37,735.11. I'll give you that number again because it's very important from a Dow Theory perspective. It's the April 15th close of 37,735.11. If, in fact, we get a close, and the Dow Theory works on closes, not intraday moves, but on closes, if we would get a close below that previous significant low, that would be a pivot in the Dow Theory from bullish to bearish. And what's interesting, Chris, is that, we're talking about potentially a shift in the primary trend of this market at a time when the S&P just went to a new all-time high. So, that's one of the benefits, I think, of the Dow Theory and of the Dow Jones Transportation Average is that, there aren't many people talking about this right now in terms of, you've got a market represented by the S&P 500. People look at the NASDAQ, just coming off new all-time highs is, hours ago.
Right.
And yet, from a Dow Theory perspective, we're talking about we're 2% away from a pretty significant potential change in the market trend. So we're not there yet, but we're close. And the Dow Jones Transportation Average behaving the way it is and has been really for the last few months kind of gets back to your point where it's been like, this has been a market that has been led by a very, very narrow number of stocks. But when you kind of look underneath that narrow leadership, you get a market that pretty much hasn't done much of anything. And the transports have really been an indicator of that. You look at the performance of the small cap, the Russell 2000, it's been pretty anemic and is probably down for the year. Mid caps, sluggish. Even the Dow Jones Industrial Average has been fairly sluggish this year relative to market cap weighted indexes like the S&P 500 and the NASDAQ. So, the transports have been doing a pretty good job of showing that this has been a very narrow market and one that isn't necessarily, lifting all boats. And again, we're only about 2% away on the Dow Jones Industrial Average from going into, a fairly bearish development for the market.
Yeah, I bring up the chart of the IWM, and this is that Russell 2000 ETF because you mentioned it. And this is, for the people who are watching that may not know, this is kind of where I say business is done, where the S&P 500 right now, especially because of market cap weighting, that's one of those sectors that can be easily buoyed by, as you said, the Magnificent Seven. All the boats in the harbor aren't going up right now. But when you look at the Russell 2000, especially with everything that's going on with inflation, which is kind of still nagging us, and most importantly, interest rates. If we've got a Fed that's not going to drop rates until 2025, maybe, which we'll get more news on that obviously this week and maybe a little bit of an outlook. But this is, I always like to say, this is kind of the reverse of the Dow theory. I like to look at the IWM and say, well, this is where speculation in the market happens. And speculation is what drives market prices higher. When people are buying because they're buying in expectation of getting another 10% or 15%. So these are your retailers, your regional banks, your small companies. And we're slipping again. This has been trading in one of those ranges, unlike the transports. And I think it's interesting, the transports have led, even when you look at the IWM or the Russell 2000, the transports have more of a damning pattern behind them right now. Have you ever looked at the transports with the Russell or against the Russell?
Well, they tend to trend pretty closely, maybe not so much in magnitude, but often in direction. And part of the reason is that you kind of hit on that. When I mentioned that the Dow Jones Transportation Average is an extremely economically sensitive index. So too is the Russell 2000, because smaller companies tend to be very sensitive to economic trends. That's why, in economic slowdowns, typically, the Russell is not the place you want to be. Because of its sensitivity to the economy. So oftentimes they do sink in terms of direction. They may not always sink in terms of the magnitude of that move. I think that, what the transports are saying and what the Russell 2000 is saying is that, we are potentially looking at a pretty, the economy is slowing. I don't think there's any doubt about that.
No,
and now the issue is just what is going to be the magnitude of that slowdown? Is it going to be, the soft landing, or is it going to be more severe? And is that R word recession going to finally, like waiting for Godot? Is it waiting for the recession that finally comes? I would think that a recession comes into play more likely if, in fact, those Dow Jones Industrial Average confirm and go below that level, and we have a bear market. Because generally speaking, most bear markets are triggered by recessions, and so you have the decline in corporate profits and all of that. So, and the other thing you brought, and you mentioned this, and I think it's worth kind of repeating, the stock market at the end of the day really is a market of small and mid-sized companies. When you look at, there might be 300 really large companies And we have a stock rating system that we developed and have been using for over 20 years called Quadrix, which ranks more than 3,000 stocks. And when you're looking at a universe of 3,000 stocks, which is really kind of the market in general, probably 80 to 85% of those are small and mid-sized companies. So what goes on in that world is very relevant from, again, giving you some guidance, a barometer, if you will, into what's going on in economic conditions. And, the Russell 2000 isn't exactly, showing a lot of optimism there when it comes to the economy.
No, it's funny you bring that up because yesterday we had the Dow hitting all-time highs, or no, S&P 500 hitting all-time highs, and you got the NASDAQ that's hovering right up there as well on any given day. And what we had a few weeks ago, I think all three for the first time in a long time, the Dow, the NASDAQ, and the S&P registered a new high on the same day. But yesterday's activity, you've got 3,000 stocks or so trading on the NYSE. Less than 1% of those hit any type of all-time high. Matter of fact, when you look at them by the sectors, I mean, there are some of these sectors that have not seen any of their stocks hit an all-time high, energy being one of them, in the last 2 or 3 months. So it's almost like there's a, let's call it a quiet, everybody quit their jobs in 2021 and 22. It's kind of like a silent correction that's going on under the skin of this market a little bit.
Yeah. And you do have, there are ways for markets to correct their excesses. Mm-hmm. There is the significant, bear market plunge. Market goes down 22% and does it in 6 months and freaks everybody out. But you can have what are called rotational corrections, where you have kind of a churning from a sector to sector. You kind of have, areas of the market that are just kind of stale. They're not necessarily eroding sharply, but nor are they gathering any momentum to the upside. And you can have that all kind of percolating underneath the surface of, the NVIDIAs of the world, which seem to defy gravity at this point. So there are ways for markets to kind of corrections to do their job of kind of restoring values that aren't as obvious. Whether we're in that type of period now or it's kind of the calm before the storm. Again, we tend to let the market tell us the story, and the market will tell us that story through the prism of the Dow Theory. And it's going to be riding on how the Dow Jones Industrial Average behaves here. The one thing I have learned over the years is the Dow Jones Transportation Average can put points on in a hurry. It's 20 stocks. It's price weighted. If the rails and the trucking companies in particular start to get their act together, you can put points on in a hurry and kind of get us out of harm's way here. But the weakness that it has shown, if it is followed by, similar weakness in the industrials, I think all bets are off for this market for the time being.
You mentioned that there are 20 companies in the transport. Name the top 5 or 10 that people are going to know right off the bat. You said the rails, so you've got CSX, so they know what you're watching.
You've got Union Pacific, and on the rails, in the shippers, you've got FedEx. You've got UPS, trucking firms. You've got Ryder. You do have the airlines as well. Airline stocks, though, because it is a price-weighted index, which means that highest price stocks, highest per share price stocks carry the greatest weight. There aren't really many high-priced stocks in the airline sector. So they're kind of I don't want to say a non-event, but they're not really significant in terms of their impact. One stock, and it's a fairly very new entry actually to the Dow Jones Transportation Average, is Uber. And that is a high price stock, and that has a pretty good weighting in the Dow Transport. So those are some of the names. And again, they ship stuff, or they ship people, or they ship cargo, and not just domestic, but internationally. They are very sensitive to other areas of the economy, such as labor prices, wages, fuel prices, et cetera. And that's why, their import is significant for the economy and therefore significant for the market.
Yeah, I think it's interesting because you can take and obviously you're trying to tap into the consumer via the economy via the consumer, or at least what's going to the shelves, I think is probably
Right.
one of the simpler ways. You know, if you and I go to the market, whether it's a Kroger, a Target, a Costco, whatever, and we're buying something, it wasn't manufactured in the back. It was shipped there. So as they start to ease back on the demand in terms of inventory, but Uber's an interesting one because that is kind of a discretionary. You're either riding it to work or you're riding it to a concert or something. Fun fact, I didn't know Uber was in the transports now.
That just happened. It just happened here when they made the changes in the Dow Jones Industrial Average here. When was that? A month or two ago?
2 months, yeah.
But I think Amazon, I believe, was added to the Dow. At that same time, again, nobody pays attention to the Dow Jones Transportation Average, but Dow theorists like us. And at the same time, they made a change and added Uber. And so yeah, it flew under the radar. But from our vantage point, it was I think a relevant change. I mean, it continues to modernize the Dow indices. I mean, Uber is a transportation related company. They just provide a service that didn't exist in a broad way, 10 years ago. So, so yes. And that, and that gets to a point that's worth bringing up in terms of that notion that, well, these are all antiquated indexes. Well, I mean, the 30 stocks that are in the Dow Jones Industrial Average today were not the 30 stocks that were in it in 1890. So, I mean, there has been modernizations over time to try to keep pace with what's going on in the economy and being reflective and still a legitimate barometer of the economy, which we think is the case still.
Well, let's roll back to something. You gave us a number, 37,700. Oh boy. And 13, I believe it was, or 33.
37,735.11. It was the April 15th close in the Dow Jones Industrial.
April 15th close. Let's go back to that chart here for a second as well. What happens? I'll ask you this. What happens? And you mentioned, and I always talk about closes. A lot of people, they'll tend to look at something and say, well, it closed. I usually count it as two closes. I say two closes are an actual break, but you're talking about breaking through this April 15 bottom right in here. Mm-hmm. What's the progression? Is this something where we slowly start to see things unravel, or as you mentioned, I mean, things can go quickly and blood can be running through the street? In my opinion, it's something where I love a quick 15, 20, 25% pullback when something like this happens, because that's when everybody's screaming and sentiment goes so red and you just can't avoid to buy at that point. But typically, what's the progression of a bearish signal here?
Well, progressions over time have really been compressed. It used to be, bear markets would stretch out 8, 12, 15 months. Bear markets typically are shorter than bull markets, thankfully, but they can also be pretty violent as well. Mm-hmm. And one of the things that I've seen over time, and I think this has to do with kind of the frictionless markets that we exist in terms of trading and so forth, and with various investment vehicles like ETFs, where you can move massive chunks of stocks in, with just a couple of keystrokes, and the technology and so forth. I think all that has served to compress market moves into shorter periods of time. So to get back to your question, what is the progression? Typically, when we see significant lows taken out by both the Dow Jones Industrial and Dow Jones Transportation Average, things get pretty spicy pretty quickly, and pretty spicy to the downside. So, it is not unusual, for example, in a typical bear market under the Dow Theory, that you see a 20 to 25% decline, and that 20 to 25% decline can happen in 4 to 6 months. Okay. So it can get pretty spicy pretty quickly. That, I would guess, that would be. I guess I don't see anything in this market environment that would lead me to think differently about the progression. That this would be one where it would be more of a water torture, drip, 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 downward, downward, downward. I think those lows are pretty established. I think that if they are taken out, there are a fair amount of people out there that may not even be Dow theorists, but they're chart jockeys, and they're looking at those support levels, and those support levels get taken out. And traders, we're more longer term primary trend guys. But there are traders out there that are more shorter term that are going to look at those points and go, you know what? We just had we've had new lower lows in the industrials. We've had new lower lows in the transports. Maybe the problem hasn't manifested itself quite yet, which typically it doesn't, because markets are forward looking. So you don't really see the reasons, so to speak, until maybe 3 to 6 months down the road. But you'll have plenty of people saying, you know what, this isn't good, and we're gonna do some selling. So I would expect the progression, the compression of the decline to be pretty severe and pretty quick in this case.
It's interesting thinking back on what we had over the last quarter's worth of earnings. And I'm that guy that I don't jump in and read the entire report. I don't listen to the entire conference call. I'm a skimmer. I look for the Cliff's notes, right? And one of the predominant messages that we heard across the board, first of all, that were a lot of companies were kind of looking to be a little tighter on revenue for the next quarter. And a lot of that came back to capital expenditures, what they're expecting to see. If you look at Salesforce.com,
right.
Salesforce.com got crushed.
Yeah.
And they said, well, our outlook for the long term into 2025 is good, but the next couple of quarters are going to be tight. And that seems to be the message that we got. And that is not being digested, I think, because everybody's still looking at AI stocks. 5 or 10 years ago, I would have listened to this trend in conference calls and went, oh my gosh, I need to start, taking some profits, or at least drawing some lines using something like the Dow Theory to say, this is where I cut back my positions and start to name the prices that I want to buy in. I don't think anybody's doing that because of AI in that one stock. I mean,
it is. It is. And I don't know if obfuscation, if I could say that word, is what the NVIDIAs of the world are doing. But there is certainly, it is a powerful investment theme. There is no doubt about it. And it has been extremely powerful for certain companies that are the major benefactors of that, such as an NVIDIA. I mean, you can't dispute, and not that you were, but you can't dispute the growth that's occurring in NVIDIA. It's amazing. So,
right.
And the profit and revenue generation that's going on there. I mean, the stock has done what you want companies to do, and the stock price has reflected that.
Right.
But again, when you start looking kind of underneath the hood at the broader market, that revenue and earnings growth seems like it might become a little more difficult. At the end of the day, Chris, simply put, markets are driven in a sustained way by 3 engines: interest rates, inflation, and corporate profits. Notice I didn't say elections. Notice I didn't say a lot of those things. It's interest rates, inflation, and corporate profits drive the longer term trend. So if you look at those 3 things now, interest rates probably have peaked. The magnitude of a decline is certainly disputed. Are there going to be 1 cuts, no cuts, 2 cuts?
Right.
But interest rates probably are at this point neutral, maybe still tilting a little bearish. I mean, if you can still make 4.5% to 5% on a money market fund, that's still a pretty strong draw to keep money there as opposed to putting it into the market. So right. I would say neutral, tilting, maybe slightly bearish. When you look at inflation has come down dramatically from those peaks. It is still above probably where you would want it to be. So that's probably neutral to slightly bearish. And then you get the corporate profits, which ultimately and historically has been the most important factor from a stock market perspective. And that is probably neutral, tilting bullish. So, when you throw that bullion base together, it kind of points to what we're seeing in the market now. Is kind of growth is really at a premium. So people are buying growth stocks, which is right. Usually the case. And everything else, where everything is kind of, it's been a market for those people here. And that's why I think that the tell from the industrial side, if in fact it breaks that low that we're talking about, that has all sorts of ramifications, but specifically ramifications, I think, on the corporate earnings side. And right. if this market is going to go into a bear market trend, it isn't going to go into that trend, I don't think, because of interest rates or inflation. It's going to go into that trend because corporate profits are going to be disappointing or not meeting expectations over the next couple of quarters. And that speaks to what you had mentioned before about from some of these companies.
And I think that's what expectations is the most important word. We talked a little bit before I pushed the button a second time about my, who I came into the business with. And Bernie Schaefer was a big expectations person using sentiment. And when I look at the market, there are three things there. That's fundamentals, the technicals, and the sentiment. And man, we are still, it feels like the sentiment towards the Fed right now is very hopeful. I hate a hope trade. I mean, I really hate it when an investor hangs a dollar in the market on hoping that something's going to happen, because that's not
hope
the right
is not
thing
a strategy.
Never ever a strategy. Fear is the opposite of that, and I can buy fear almost every single time I see it. It's the old Warren Buffett. If there's blood running through the street, you can go lower, but you're going to see those prices, bounce at some point. But the technicals we've discussed, you've kind of got this weakening of the S&P 500 limping up, but the transports, I look at that and say, wow, technically weakening. This feels like we're one thing away, and I'm not sure what that next thing is, but my gut is that it's NVIDIA cracking through what's now 100, would have been 1,000, and people saying, you know what, I've made my hundreds or my thousands of percent. It's time to lock in some profits and I'll buy it back lower. And that's going to telecast itself out to the rest of the market going, there's a problem with the AI trade. It's the smoke in a crowded theater type of situation.
A bit. I think, NVIDIA or the AI theme in general, because one of the things that's going to happen at some point, and I'm not the only person espousing this, but trying to know when it's going to happen is what the $64,000 question is, comps are going to come back to haunt these companies at some point. And, is it going to be comps, quarterly comparisons a quarter from now, 3 quarters from now? I mean, NVIDIA, as great a company as it is not going to continue to be able to triple the revenues year over year. That ain't going to happen. So that's where I think the potential story starts to kind of, I don't want to say break down, but starts to become a little less attractive, especially for traders, as these comps. And you're starting to see a little bit. I mean, Salesforce was a good example of maybe, having some comp problem in terms of what's going to happen over the next quarter versus a year. We're just not going to be probably growing as well. So that could be, I think, a lot of times we don't really know what the problem is until the market's already declined, and then it manifests itself. It goes, oh, geez, and that also works coming out of these things. I mean, I can't tell you how many times, Chris, it's like, when the market and the Dow Theory has shifted from bearish to bullish after a recession, people go, "You're crazy! Look at the window; things are awful," and they usually are. But the market is looking 6 months down the road, saying, "We have bottomed, and maybe this thing isn't going to be surging off the bottom, but the worst is behind us. The market has discounted it. It's time to go buy stocks." And so
that's the big thing.
We'll see how that goes here.
Yeah, the market's discounted. I think a lot of people forget that it's a discounting mechanism. We say that all of the time. And you're not necessarily investing in NVIDIA right now for it to go to, well, it would be 200 now. I've got to get the 10. Thank God it was a 10 for 1 split, because if they'd done something wonky, I wouldn't be able to do that math that quickly. But those expectations, as soon as they get dashed a little bit, you come back and you say, okay, looking forward 6 months from now, I'd love to buy NVIDIA at $80, a share or something like that again. Right. And I think,
because it's certainly growing into its valuation. I mean, you look at NVIDIA and the initial thing is, boy, it is so pricey. It is so, but when you start looking at, what the numbers are putting up, and you start looking at PEs, I mean, NVIDIA is cheaper than Procter & Gamble, really.
Yep. They're earning that value.
So it's the timing. It's the timing, really. If you're a trader, it's like, when do you go in there? And again, if you do have a bear market signal, you know, those are the types of stocks you have on your watch list, and you might be able to pick up those stocks, you know, 20, 25% cheaper, 30% cheaper than they are right now.
All right, that's on the other side of what happens here. Typically, when you get these type of signals, a Dow Theory signal that turns bearish, we turn into a new cycle. What turns into, and I think I know one of the answers right now, just because of interest rates, and we discussed 4.5% to 5%. What turns into the safe haven? What's the safe harbor? Where I think right now utilities are shining a light because people are saying, well, rates are going to come down, and I want to get in front of the run into the utility space. Historically, are there a couple sectors that turn into a safe harbor automatically with a Dow transit signal like this?
Yeah, and I guess I always kind of caution the word safe harbor. Right? I mean, in a bear market, you know, there are going to be some stocks that defy the odds, but they're not. I'd love to sit here and tell you I have a list of all the ones that will, and I don't. I think utilities historically are a defensive area for the market, and they're getting a little bit of an extra bid these days because they've taken on a certain sexiness because of AI and the energy demands that AI is putting on the grid, and so you're getting, you know, from data centers and also this ongoing electrification of everything out there that it's made utility stocks all of a sudden look like growth stocks, or the perception is potentially it could be growth stocks. So they've gotten a little bit of sex appeal to them, and they typically, because of their dividend yields, tend to be a safe haven. That is one. I think in this type of market, as is the case with bear markets, you know, you still want to try to find growth, but you want to try to find growth in areas that there is still some reasonableness to the valuations and where they have a history of maybe being a little bit of safe harbor. So, you know, a stock that comes to mind for me is Chubb, CB, the property casualty company, decent dividend yield, decent steady growth, never going to be at the top of the leaderboard in a rip-roaring bull market, but it is kind of those steady Eddie stocks that you know will hold up. That's not to say they won't go down, but they'll hold up typically better than the overall market. So a stock like that, you might look at, you know, healthcare tends to be kind of recession resistant, and you know, you start looking in the healthcare space. And, you know, that's a pretty good looking chart you have right there.
That's your healthcare. That's your XLV, your healthcare ETF. And the chart before was Chubb, Mr. Buffett's new favorite stock. Right?
Yeah. And that's, you know, and there, you know, and again, that's a pretty nice breakout from a sideways motion there. And that may be a further indication of, you know, economic slowdown. Do we want to get a little bit more defensive? What's an area to get defensive in? Healthcare is not a bad place to be. You get some dividend yield on some of the larger healthcare stocks. You get some M&A potential activity in some of the smaller healthcare stocks. So you get a market like that, or a chart like that, you know, after several months of trading sideways is kind of broken out of that trend. So I think that's an area to answer your question as well. So there are pockets out there. I would caution that you still want to try to have a growth factor, because again, I think if this market is going to deteriorate, it's going to be an economic slowdown, recession, poor profit driven decline. And in a market where growth is hard to come by, you want to have some growth, and you can get them in those areas, I think, still.
So let me switch that, because we've talked about declines in the market, and let's make it a little different. What about gold? What are your thoughts on gold? And is there a tie-in with the transits? Because gold is, I once had a teacher, and I think everybody's got a story that starts with, I once had a teacher. I once had a teacher at the University of Cincinnati that told us, just buy gold and you'll retire early. And it's gold is always, yeah. And you know, full disclosure, he was still working there, I think 10 years ago. So it didn't work out that well. And I figured out long before that gold was a trade. But gold has certainly turned into something that the market is definitely behind right now, whether it's because of fears of the election. I just read an article that Gary Trudeau had somebody write something up about how a civil war in the United States would affect Canada. I mean, we're going everywhere right now with all of these theories. And gold has finally, gold has a little luster to it. You have any comments on gold? Do you have any thoughts on it?
Yeah, I will preface my comments by saying that we do hardly nothing in gold.
Sure.
And part of that is that we have a very disciplined, consistent investment process here at Horizon Investment Services, as well as in the publishing side at Dow Theory Forecast. And that investment process is really driven to a large extent by our Quadric stock rating system. That's really the cornerstone of our research efforts. And so gold, quite honestly, just doesn't fit very well into our process because, we're looking at more than 90 different data points to score a company in our system. And gold doesn't have any of those data points, right? It doesn't have at least what we're tracking. And that's a problem for us. So we don't have a tool that we feel confident in helping us value what is a good price for gold. And I think that is a problem. I mean, gold doesn't generate a cash flow. Gold mining stocks do, but they're just notoriously awful stocks, to be honest.
Yeah.
So gold doesn't generate any cash flow. I don't really have a way to value gold to give me some idea of what fair market value or what a good price is. So it is the ultimate in my mind, maybe not the ultimate, but a trading vehicle for sure that really is driven by, as you mentioned, speculation and that's tough for us. So I do think that it is interesting to me, the behavior of gold here in a market environment where interest rates have risen, yet gold prices have risen. Usually you don't see that. It's because it doesn't generate cash flow. Typically, higher interest rates present a huge opportunity cost for holding gold because if I can get, again, 5% on my money market fund and I get 0% on my gold,
right?
Why am I going to hold gold? So that's interesting to me that it is defying kind of a traditional way of looking at gold, that it is rising during a higher interest rate environment, which means, and the other thing is too, gold often gets played as it's an inflation hedge. But if you look at history, it's not a great inflation hedge. What it is good is a chaos hedge. And that seems to be the major play for gold right now. You have a lot of chaos in the world. You have a lot of central banks seemingly buying gold right now and propping it up. And so if that's the case, and if you believe that the chaos theme is going to continue, gold can probably continue to do pretty well. I have been thinking a little bit about that, though, from the standpoint that I just wonder if the chaos bet is going to accelerate, or is it so discounted in the market and so assumed that it isn't going to accelerate? And the next surprise might be something, akin to a détente in the Ukraine-Russian war, or something happens in the Middle East or something. So I would not necessarily be an aggressive buyer of gold right now, and probably would take some of my chips off the table. The other thing is I look at gold kind of in relative terms, right? It's in most of the time, markets go up 3 out of every 4 years since 1926. So I'm a stock guy. I think I have so much money. Where do I want to allocate that money? And typically stocks win that allocation bet versus gold. Having said that, to have a gold as piece of a portfolio as a chaos hedge, particularly in the type of environment we're in right now, I wouldn't arm wrestle somebody and say that's a bad idea. But I do think maybe there's the prospect of maybe some of the bloom coming off the gold rose here over the next 6 months.
I think you're right, especially as I think everybody's going to point to the elections that are happening in November. And like we saw with the last election cycle, as soon as we got to the other side, actually the last two, as soon as we got to the other side and there was certainty. And I think that's the thing that the market doesn't see right now is certainty, right. Especially with polls tight, who knows what's going to happen. But, on that Wednesday morning in November, we're going to wake up and know who's the president. Hopefully we don't have something that's drawn out, but we'll have a piece of that puzzle that'll take the certainty off the table. And I think that's where your gold trade really starts to fall apart. And the other side of that is I always had this weird feeling on gold. I love it as a short-term, maybe hedge against chaos, but on the other side of something that really happens to make gold go through the roof, I'm going to be worried about a bunch of other things, including the rest of my portfolio, probably. Right. So, if it's hedged, then maybe I should be sitting in cash, or maybe I should be really.
Yeah, I think, especially now, you're getting a little bit of a free ride because of the cash, which isn't going to last forever for sure, right. But it is an easier place to hide if the chaos theme, and if you have a little bit of gold, that's fine. It just feels to me like that's been played out a little bit. Again, your time frame's shorter than mine, and from a short term perspective, that chart you had up of gold looks like there's still room to run there.
Let's look at that monthly. I'll bring that monthly chart up again right here. So there's your monthly. So on a monthly chart, this thing has run well.
Yeah, it has, and it looks. You had that breakout, and it looks like it can run a little bit longer. I think, longer term, I'm a little suspect, but it's tough to. That's a good looking chart from a trading perspective.
It's a handsome chart. Let me put another one in front of you very quickly, and I hope I'm not giving something away off of your notes, but has something to do with utility or transports a little bit. I saw you had a note on this just earlier this week, I think. Mm-hmm. No, it was last week. Booking.
Yeah, which Booking Holdings is, the big travel, I guess, the new digital travel agent, and it's done a nice job. It's had pretty good numbers, and it's growing. So in terms of the representing the leisure consumer, we still want to do stuff. Booking is showing a pretty good. Although it's interesting, Booking has really done well, but you look at some of the other players in their sector, kind of quasi in their sector. I think, like if you had a chart of an Expedia, for example.
How about this guy, Airbnb?
Airbnb, yeah, that is not a Booking-like chart right there. So there's kind of mixed messaging going on in that space, and there's definitely some companies that are doing well, and there's some other companies that where those charts aren't looking that well. So it's not a consensus area for strength right now. But Booking certainly has been a nice stock for us. There's no doubt about it.
This is a great, and I wonder when I look at this and I compare it to some of the stocks, let's say the airlines, which you mentioned earlier, you've got Delta, you've got, you can put them into different categories. And I always think, and I'm a Delta person, so they've got me. They've got me by the Sky Miles hooks, right? But you typically stick with an airline. I find that a lot of people are price sensitive, but if it's an extra $20 or $30, I'm going to go every time with Delta. Right. And I wonder, looking at Booking, this is a little more looking into the background of Booking. There's a lot of corporate activity that goes through Booking, and it's not like an Airbnb, where Airbnb is more discretionary. It's getting away with, your significant other, the kids, or it's a vacation, which I think we're going to see more pressure because the consumer is tapped out when it comes to what's happened with inflation and interest rates. But I love your Booking chart. Booking has a pretty substantial
international business as well.
Mhm.
So, they're kind of giving you a little bit of a read overseas. And one of the stocks that, I watch and I actually personally own is Ryanair, which is kind of the discount flyer
Yep.
in Europe. And I can't say I'm a huge fan of airline stocks in general. And that stock has had its share of volatility, mostly driven by the fact that Boeing can't get them airplanes. But it actually looks pretty well. It's performed pretty decently as far as airline stocks have gone, and I think that reflects, that they're flying in an entirely different environment in Europe. But yeah, that's a tough area here. I mean, there are some stocks in travel and leisure that have been hanging in there. Marriott has been okay as a stock,
Yep.
and so there are some. Yeah, I mean that's had a nice move. It's pulled back here very recently, but I mean that's a chart I can live with. But there are some other ones that have been, a little gamey.
Yeah,
I am. What's the time frame on that chart?
So that's a daily on Marriott. So
it is. Okay.
Yeah, when I look at my, when I have my my shorter term outlook on it, I look at this and say, "Ooh,
it doesn't look that great on that daily chart for sure."
Yeah, a little concerning. You got the 20 crossing below the 50 there, and the 50 in the downtrend. My general rule on the 50-day is, everybody talks about the trend is your friend. That's the one thing, whether it's the S&P 500, whether it's the cubes. I did a study back in 2003. I think it was after we were putting everything back together after the dot-com bubble. It basically summed it up by if a stock or even an ETF is trading above its trending, bullish trending 50-day, it had a 67%, a 2 to 3 chance it'd close higher the next day. It got that simple. And became one of my golden rules. I try to avoid stocks that are not that I would avoid Marriott, but in this little pattern, traders have taken control.
Yeah, and from a trading perspective, there are a lot of other fish in the ocean to take a look at. As opposed to kind of breaking a rule. And again, it speaks to, I'm going to put my, preacher hat on and talk to the choir here for a minute. But I mean, basically, if you've developed a bad investment discipline is better than no investment discipline at all. And so if you are an investor and you have developed a process and it has been reasonably effective for you, follow it. Because typically, and there may be times when it doesn't work, but I mean, if you're like a leaf blowing in the wind and just chasing, because what happens is you just end up chasing stuff. And, stick to your investment philosophy because, like I said, there's another horse race running somewhere that you can hop on that horse. And so it doesn't make sense to really go against that.
That's exactly right. By the way, this is the daily chart of booking.
Okay.
Which I absolutely love right now because you've got a little period of time with this consolidation. You and I have talked shortly about different ways that a stock can correct or the market can correct. On a short-term basis, that's a fantastic little consolidation. And as soon as you see it break out of those highs, booking is going to run again. I mean, this is a great chart.
Chris, I don't know if you can pull it up. But while we're talking about moving averages, I want to kind of show a tool that I think is an excellent tool for kind of giving you an intermediate, say 4 to 6 month perspective on stocks. We call it our intermediate potential risk chart. And it's the second slide in that basket that I gave you at the beginning. So there was the one of the two of the Dow the stacked industrial chart, but it's the one behind, it's the next one.
I tell you what, can you change it on? You should be able to change it on your screen there.
Oh, okay. Oh, here. I'm sorry.
Got it?
Yeah. Can you show that?
Let's go.
Perfect. We call this our intermediate potential risk indicator. And what it shows is the percentage of stocks on the New York Stock Exchange that are trading above their 200-day moving average.
I love it.
So, you're a 50 day, maybe even a 20-day or whatever. I look at a little bit longer terms of 200-day moving averages. And I view this chart, and we view this chart a little bit differently than a lot of people view how stocks behave around their 200-day moving average. I look at this as a tool to help me understand the concept of mean reversion. Mean reversion basically says stocks can move. Mean reversion says that most of us in weather exist at some kind of golden mean, an equilibrium point. But there are times when things get out of whack, where you have hurricanes and you have tornadoes from a weather standpoint, or as a person, you have, we live our lives at some equilibrium level, but there are births and deaths and divorce, and we get these spikes in there. Again, things don't stay at those spikes because it takes too much energy to generate those spikes. As the energy dissipates, we come back to this equilibrium level. I think there's an element of that in stocks where now I have an MBA from the University of Chicago, which is, the bastion of an efficient market theory.
Yep.
But, I've also been in the business for over 40 years. And I can't tell you that markets are incredibly efficient all the time. And this is a tool that helps you determine those periods when things get out of whack. And in essence, I look at a stock's 200-day moving average as kind of an equilibrium level for a stock price. Because to get a 200-day moving average, you need a lot of points. You need 200 days to get the next day. You drop a day, add a day. So to look at a 200-day moving average, which typically trends upward because stocks typically trend upward, is an equilibrium range. So what this chart says is when you have lots and lots and lots, and I'll quantify it in a moment, stocks trading above that equilibrium level, mean reversion says at some point, stocks are going to start to come back down and migrate to that equilibrium point. Conversely, when you have very few stocks trading above and most of the stocks trading below, you would expect the market at some point, those stocks to trend upward to that equilibrium level. So basically, this is kind of a snapshot. You can use it as a sentiment snapshot. You can use it as a snapshot for kind of ebullience in the market. And it works best, like a lot of these tools, at the outlier positions.
Yep.
As you can see, we kind of quantify this as lower risk, neutral risk, and higher risk. So anything above 70%, we deem higher risk in the market. Stocks are popular, which means they may be more fully valued, which means there may be a decline. And in lower risk, and it's the opposite, where stocks are out of favor, which means they may be offering better prices, which means maybe there's a buying opportunity. And this works best at the outliers. So typically 80 and above on the top end, and anything 20 below. If you look at this chart now, and this is all, I'm going to make a broad point here in a moment, but if you look at this chart, you go back to 2008 and 2009. If you want to know just how bad things were in 2008, 2009, this chart tells you. And what this chart shows is that in 2008 and 2009, at those bottoms, there were 2% of the stocks on the New York Stock Exchange were trading above their 200-day moving average, just 2%. Now, if somebody would have said, okay, Carlson, I started to buy when it went below 20%, and then the market proceeded to go lower, well, yes, that's usually what happens because you're not going to buy at the exact bottom.
Right.
But I will tell you, if you bought when this got to be 20% or below, you were really happy you did 12 months later, 24 months later. So you can fast forward and see areas where this market is really bottomed out and areas where this market got toppy. Go back to, if you go up to like 2020, you can see that's the COVID dump in the market there. When it got down to, 2%, and yeah, the world was ending, and you weren't just worried about your portfolio at that point, you were worried about whether you were going to live or not. There's a lot of fear in the market. And as you said, you got to buy that fear. And this helps you buy the fear. So where are we now? Well, we're just coming off creasing above 70%. So we got into higher risk. We didn't exactly get into the above the 80, which really worries me, but it stock sentiment, et cetera.
Right.
was in the higher area, and now we are working our way a bit lower. Right now, we're at about 63%. We're not at 20. And, this kind of ties in a little bit with, the broader Dow Theory theme here, where it's like, okay, stocks are kind of eroding a little bit from their peak levels, but they're still at levels that are still on the high side here. So there is more room to fall if, in fact, those industrials are taken out. So I just thought I would interject that in here as we were talking about moving averages, et cetera.
That's a great, and I'm going to switch it over to this. Oh, it didn't switch correctly. Hold on a second. Let's see if I can get this, because you mentioned I love the 50-day.
Mm-hmm.
Same thing with the 50-day. There we go. So there's your 50-day, and as it's the same idea. I love explaining this, like the rubber bands. If you're using the 200-day in your case, rubber band snaps at some point. Otherwise it's just going to break. And the same thing when it goes down. And you notice here with the 50-day moving average, same exact data. Number of companies in the S&P 500 in this case trading above or below their 50-day, and it gets down under 10%. And that's the time when you can go in and say, okay, the rubber band is ready to snap back up towards that mean again. So I love the fact they're both coming together, and you've got a Dow theory that's kind of evolving into and this will gyrate much more though, but I don't look like the way this looks actually when I combine those three, because it tells me short term or intermediate term, maybe we'll have a little bit of weakness. And then from your perspective on the 200 days, if we start to see that correction, that'll be a little bit more elongated. And the Dow theory could obviously be the thing that backs all of that.
Yeah. So that it all kind of points to the possibility, right? But again, it's important. The primary trend under the Dow theory is still bullish. And so, we are still working under that assumption. We're not in a portfolio that we can be 100% invested. We are still in that 85 to 88% range. But we're not 100%. And if the Dow industrials get taken out, we will reduce that exposure more. But it's and again, I kind of preface all this by saying, it's happening at a time when the S&P 500 just went to a new all-time high yesterday. So, it is flying under the radar here, and but it is something that your listener should be aware of.
Yeah. Well, I love it. I love the outlook here. We're going to have to get back together in a month or so and check back and see how this has all gone.
Yeah.
Anything that you mentioned you would be reducing if we break that level on the Dow. Give the people that number one more time, please.
That's number 37735.11. And it was the April 15th close.
Okay. If we break down below, you start to you personally, or you as an investment professional, which we're obviously not giving that advice right now to everybody, but you start to look at raising a little more cash at that point and start to eye opportunities at some point down the road.
Yes. And again, we are not, and I don't advise, all or nothing market timing. What we try to do is cushion the blow and make adjustments at the margin. And probably most importantly, raise some powder, because, there's going to be some opportunities here, and to be ready for that and start to develop a list of stocks, both that would represent maybe your early exits as well as the ones that you want to get in the portfolio. And, bear markets stink, but that's when you kind of make your hay, especially if you're a long-term investor. And, it's easier said than done, but the fact of the matter is that is when you build wealth, quite frankly, is how well you capitalize on those opportunities that develop during a bear market.
Yeah, I always love to tell the story. My sister called me once, and this was during right when the pandemic kicked off. And she said, what do I do? Do I sell everything? And I said, no, you don't sell anything. It happened too quickly. You just hold on to what you've got. And if you've got some cash, maybe you put it into work here. She made the same call when we had that set up for 2022 that was looking just really dour. And I explained, there's usually 3 cycles to a bear market. Whenever I see commodities and everything starting to fall off, that's when I look and say, okay, we're heading. She said, what do I do? And I said, I don't know, sell half of what you want, what you've got, and then simply dollar cost average. Wait 2 months, take a couple deep breaths, and start putting 10, 15, 20% of what you've got in cash back in what you sold. And she called me back a year later and said, I can't believe how well I did through this. Sometimes it's, the tortoise had the right idea, right?
Yeah. And you had the right idea for an investor. I mean, there has been tons of research that has shown that over time, the biggest weapon that investors have is how well they harness the power of time for a long-term investment program.
Yep.
And you harness the power of time by getting in the market as soon as you can. However, from a practical standpoint, what I have found is that, and your sister is a good case. It's like if you just said, okay, now's the time for you to get all your money back in. They're not going to do it because there's the fear factor. I'm going to be doing it at the exact wrong time.
Yep.
So while dollar cost averaging probably it infringes on the power of time because you're not putting all in and having it at time. It is a palatable way to invest because you can get somebody to do that. Okay, I'm going to do 10%, 10%, 10%, as opposed to pushing all the chips into the table. And
that's exactly right.
I still do that too. And so it makes a lot of sense, and it especially makes sense if you're trying to get people to buy in a bear market because 2 things happen that prevent people from buying. And one is, well, the market's rebounded. I'm not going to buy now because it's rebounded. I'm going to buy when it comes back down. Or the market keeps going down. Well, I'm not going to buy now because it keeps going down. So you never buy. Right. So you never get back in. And
exactly.
And the dollar cost averaging way is truly a way to go about doing that, I think, in a great palatable way.
Well, this has been a great hour of my time. I hope yours as well.
Thank you. It's been fun.
Yeah, this has been great. Let's make sure to do it again and check in on the Dow. You know what? You'll be one of my first emails if we break that level on the Dow Jones Industrial Average.
Very good. I kind of hope we don't.
I kind of hope we don't. But
we'll let the market. Again, we let the market tell the story here, and it'll tell the story here. And my guess is probably in fairly short order we'll know.
Yeah. Well, I will put in an alert on that level and be in touch with you if we do hit it, Chuck. Hope you're happy with that.
Thank you.
All right. It's been great talking to you. For everybody else out there, leave your comments, like, and subscribe. We'll have more interviews with people like Chuck. Great learning that's going on here today. I really actually Uber being added to the transports. I already know one thing I learned. So thanks again, Chuck. Appreciate your time.
Anytime. Thanks, Chris.
All right. Have a great day.
Bye-bye.